What if the market just told you something most headlines completely missed? In less than 24 hours, global markets staged one of the most violent risk-on reversals of the year, and it wasn't confined to a single asset class. Silver collapsed to $65 during the prior session, then surged to $78 within a day, a 22% swing that most investors would expect to take weeks, not hours. Spot prices confirmed the move globally. London silver traded around $77.16, while Shanghai spot pushed near $82, signaling synchronized demand across Western and Asian markets. At the same time, Bitcoin jumped roughly $11,000, reclaiming the $70,000 level after weeks of pressure. That move alone helped drive more than $340 billion back into the total crypto market in a single day, while approximately $550 million in short positions were liquidated, forcing momentum traders to chase price higher. This wasn't cautious buying, it was aggressive repositioning. U.S. equities echoed the same message. The Dow Jones surged nearly 950 points, printing a new all-time high. The Nasdaq and S&P 500 fully erased the previous day's sharp sell-off, while the Russell 2000 jumped 3.1%, adding close to $100 billion in market capitalization. Small caps leading the rebound matters. It signals investors rotating back into higher beta, higher risk assets, not hiding in defensives. When metals, crypto, and equities all reverse violently in unison, that's not noise. It's capital moving with urgency. Welcome to GB Economy. At GB Economy, we don't chase sensational headlines, hype, or short-term narratives. We focus on market structure, historical patterns, and verified data to help you understand why markets move, not just what moved today. This channel is for educational and informational purposes only. All data, analysis, and opinions presented are intended to explain market structure and risk dynamics, not to provide personalized investment recommendations. But that violent rebound raises a deeper question. What actually broke during the sell-off? Real demand, or just paper positioning? The data points clearly to the latter. The recent drop was not a collapse in physical silver demand. It was a flush of leverage in the paper market. The clearest signal comes from London. As prices were falling, the one-month silver lease rate spiked to 6.1%, an exceptionally high level by historical standards. In simple terms, this is the cost professionals are willing to pay to borrow physical silver right now. If silver were abundant, that rate would collapse towards zero. Instead, it surged. Markets do not pay premium rates to borrow something that is plentiful. They do so only when physical supply is tight. At the same time, silver remained in backwardation, meaning near-term physical silver continued to trade at a premium to future contracts. Backwardation is rare in precious metals and almost never persists during periods of genuine demand destruction. Its presence during the sell-off tells us that while futures and leveraged positions were being liquidated aggressively, physical metal was not being dumped. The conclusion is straightforward. What we witnessed was a forced unwinding of paper leverage and speculative positioning, not a breakdown in real-world demand. Power, futures, options, and margin trades were flushed out at speed, while the physical market quietly tightened underneath. That distinction matters because markets driven lower by leverage resets behave very differently from markets broken by collapsing fundamentals. Following the leverage flush in the paper market, the derivatives data adds another critical layer of confirmation. Speculative positioning has already been washed out. On COMEX, total gold open interest fell to 400,952 contracts, the lowest level since December 2018. That is not a routine pullback. It represents a large-scale exit of short-term traders, momentum funds, and leveraged participants who were forced out as volatility spiked. Historically, this type of contraction in open interest occurs after selling pressure has largely exhausted itself, not at the beginning of a downturn. When markets fall and open interest collapses at the same time, it signals that positions are being closed, not that fresh bearish bets are being added. In other words, the fuel driving the decline is being removed. What typically follows is a period where price stabilizes, volatility compresses, and once confidence begins to return, speculative capital flows back in. When that happens, open interest expands alongside price rather than against it. This pattern has repeated multiple times across precious metals cycles, including the 2018-2019 basing phase, when a similar washout preceded a sustained recovery. To be clear, this does not guarantee that the absolute low is in. Markets can remain unstable even after positioning resets. However, from a structural standpoint, the data strongly suggests that forced selling is already behind us. At this stage, downside risk increasingly depends on new fundamental shocks, not on residual speculative excess. While paper positioning has been aggressively reduced in Western markets, the physical silver story in China tells the opposite narrative and at an increasingly alarming pace. Since 2020, an estimated 6,600 metric tons of silver have been withdrawn from Chinese exchanges and vault systems. That represents roughly 90% of reported exchange-held inventories and is equivalent to nearly 30% of annual global silver mine supply compressed into just a few years. This is not speculative churn. This is sustained, structural accumulation. As of the most recent data, combined inventories at the Shanghai Gold Exchange, SGE, and Shanghai Futures Exchange, SHFE, stand at approximately 850 tons. On its own, that figure may not appear critical until daily flows are considered. In a single session, roughly 73 tons were withdrawn. At that pace, inventories would be effectively exhausted in about 11 trading days. Even if withdrawals slow, the direction is unmistakable. Physical silver is being steadily removed from accessible supply. Crucially, this behavior has been most aggressive during price weakness. Rather than chasing rallies, Chinese buyers have consistently used pullbacks to stack physical metal, a pattern that has repeated throughout multiple commodity cycles. This is strategic accumulation, not short-term speculation. It also explains why physical tightness persists even as futures markets experience sharp liquidations. The implication is clear. While paper markets can reprice rapidly under leverage stress, physical flows move quietly but decisively. China's sustained drawdown signals that real-world demand is not only intact, it is intensifying beneath the surface, tightening the global silver balance at precisely the wrong time for already constrained supply chains. All of these pressures converge at a single, highly time-sensitive point, the COMEX March 2026 silver contract, where the system's structural limits are about to be tested. As of early February 2026, open interest for the March contract stands at approximately 429 million ounces. Against that exposure, registered silver inventories on COMEX total just around 103 million ounces and continue to decline. The imbalance is not theoretical, it is measurable and immediate. Recent delivery behavior makes the situation even more precarious. In February 2026, the delivery rate reached 98%, an exceptionally rare outcome for a futures market that normally settles the vast majority of contracts in cash or rolls them forward. Such a high delivery rate indicates that contract holders are no longer content with paper exposure, they are demanding metal. The math is unforgiving. If just 25% of March contract holders stand for delivery, COMEX would need to supply roughly 107 million ounces, already exceeding the upper end of available registered inventory. Should delivery intentions rise to 50-70%, which would align with recent delivery intensity, required supply would jump to 200-300 million ounces, far beyond the realistic delivery capacity of 85-103 million ounces. With only 21 days remaining until first notice day, the window for adjustment is rapidly closing. This 3-week period is not about price volatility, it is about system functionality. Futures markets can absorb leverage resets, but they cannot conjure physical metal on demand. If delivery pressure persists, March 2026 may force a repricing event not by speculation, but by arithmetic. Placed against that near-term delivery stress, it is easy to lose perspective, but the long-term structure of silver remains intact. When silver is measured not in nominal dollars but relative to US SSM2 money supply, the recent decline does not resemble a trend reversal. It aligns with a classic retest of a multi-decade breakout zone that was breached during the previous advance. In structural terms, this is a validation phase, not a failure. Historically, major silver bull markets do not move in straight lines. The 1980 and 2011 cycles both included sharp drawdowns that temporarily convinced participants the trend was over, only to resume higher once liquidity and positioning reset. Importantly, current prices have not even exceeded the 2011 nominal high, yet sentiment has already swung from euphoria to dismissal. That mismatch between price level and psychology is itself revealing. This is where time frame becomes decisive. On a daily or weekly chart, the move looks violent. On a long-term, money-adjusted basis, it remains proportionate to the expansion of global liquidity since 2020. The same monetary backdrop, persistent deficits, rising sovereign debt, and structural currency debasement has not disappeared in the last few weeks. The key distinction is direction versus duration. Direction is defined by fundamentals and monetary structure. Duration is defined by volatility and positioning. Confusing the two leads to premature conclusions. The current setup challenges patience, not the underlying trend. Even with a constructive long-term backdrop, risk has not been fully extinguished, and the key early warning signal remains Bitcoin, the canary in the coal mine for global risk appetite. History is unambiguous. Every major Bitcoin bear market over the past 14 years has produced drawdowns of at least 75%, with deeper declines of 93% in 2011, 84% in 2015, 83% in 2018, and 76% in 2022. While each cycle has bottomed at progressively shallower levels, the pattern still implies meaningful downside risk during periods of deleveraging. Applied to the current cycle, a historically consistent 70% drawdown from the peak would place a potential Bitcoin trough near $38,000. That level is not a forecast, it is a statistical reference derived from prior market structure. The implication for precious metals is straightforward. When Bitcoin remains under technical pressure, broader risk sentiment tends to stay unstable, and silver and gold often experience short-term headwinds regardless of their stronger fundamentals. This is why caution remains warranted. The recent rebound in silver and the broader risk-on move show signs of exhaustion in selling pressure, but confirmation requires time. Markets rarely move directly from liquidation to sustained advance without consolidation. Until Bitcoin stabilizes and forms a clear base, volatility across metals is likely to persist. In short, the ingredients for a durable low are forming, but discipline matters. Recognizing a potential bottom is different from declaring one. At this stage, the data argues for awareness, not certainty. With physical tightness building and paper excess largely cleared, the next phase of the cycle may shift towards silver equities, where a long-delayed catch-up move is beginning to take shape in 2026. History provides a clear framework. During the 2002-2011 precious metals bull market, silver prices rose roughly 300%, while leading silver miners delivered gains of 500% or more, 5 times the move in the metal itself. Across cycles, the average silver miner has tended to amplify silver's price performance by roughly 3 to 1. That leverage has notably failed to appear so far. Throughout 2025, silver prices advanced aggressively, yet many mining equities lagged badly, at times barely matching or even underperforming physical silver. Valuations remained anchored to outdated assumptions of $35, $40 silver, despite spot prices trading far above those levels. This disconnect is now approaching a breaking point. The catalyst is earnings. Beginning in early 2026, major silver producers are set to report results that reflect dramatically higher realized prices. For a producer generating 10 million ounces annually, even a modest increase in silver price translates into multiples of prior quarter cash flow, in some cases exceeding 0% profit growth versus periods of suppressed pricing. Those numbers cannot be ignored. Analysts will be forced to revise forecasts, upgrade price targets, and re-rate the sector accordingly. As Bloomberg has noted, banks do not possess infinite balance sheets to suppress metals indefinitely through paper markets. When physical constraints assert themselves, equities tend to reprice rapidly. If history rhymes, silver miners may soon begin closing the gap they've left open for years. All of the evidence presented converges into 3 core conclusions that define where the silver market stands today. First, the violent reversal from recent lows, a 22% surge in less than 24 hours, strongly suggests that selling pressure is being exhausted. Forced liquidations and leverage unwinds appear largely complete. However, exhaustion does not equal confirmation. Markets often require time to stabilize, and a durable bottom is validated through consolidation, not speed alone. Second, the physical structure of the silver market is exceptionally tight. A London lease rate near 6.1%, persistent backwardation, aggressive Chinese vault withdrawals, and a growing mismatch between paper exposure and deliverable supply on COMEX all point to the same conclusion. Physical silver is becoming increasingly scarce at current price levels. These are not conditions associated with healthy surplus, they are symptoms of structural strain. Third, the next 3 weeks leading into March delivery are decisive. With 429 million ounces of open interest facing barely 100 million ounces of registered inventory, the market will be forced to choose between 2 outcomes. Either silver undergoes a repricing event driven by delivery stress, or the recent surge proves to be a relief rally preceding another phase of deleveraging. Thank you for watching. If you found this analysis valuable, or if you see the risks differently, share your perspective in the comments. Constructive debate sharpens understanding, and your insights help move the conversation forward.